Well, today I have with me a very special guest. We're going to not just talk about the year gone by, but how somewhat 2081 is going to be. They're calling it the Vikram somewhat 2081. Is it going to be really as victorious for the markets? Because as we're approaching Diwali, it's looking a little bit shaky. So let's try and understand all of that with Hiren Ved from Alchemy Capital joining us right here in the studios. Hiren, first of all, a very happy Diwali. I know the markets could have been a lot better for it to be a happier Diwali, but here's hoping a brighter year ahead.
Yeah, I mean, we've had a good year.
Yeah.
So, well, happy Diwali to you as well, Ayesha, and to all the viewers of ET Now.
You know, Hiren, I remember the last time you were in the studios, you were talking about Sholay. Of course, it was in the context of the defense stocks, ki jab tak hai jahan main nachungi, right? The Basanti song. Are you finally seeing Gabbar in the market? I mean, what is the market telling you right now?
So, I think we're kind of seeing a pause in the momentum, and I think that's also to do with the fact that earnings growth has also paused, right? We've seen a very tepid Q2, and I think markets are responding to that. I think the first half has been very slow, both from a GDP growth perspective, from an earnings perspective. But I'm very hopeful that second half we should see an acceleration, right? I think what this loss of momentum to me is largely because generally Q1, Q2 are slower quarters, but also I think because of elections, the government has not been able to really spend on capex as much that they had budgeted, right? So I think we budgeted 11,000 crores. That's roughly about 93,000 crores a month. But if you look at the data for the first 5 months, we've only spent at the rate of 58 to 60,000 crores. So spending is down 35% year on year, or compared to what was budgeted. And I think that is causing a little bit of a slowdown in the economy, apart from other reasons.
So that's the domestic angle.
Yes.
The FIIs, they were in any case not India's friend. They were not putting money in India for the last 1 year. But in just the last 1 month, they've sold about 1 lakh crore rupees. It pinches now because it's a weak, shaky market. What explains that?
Well, I think partly it is the fact that China stimulated the economy massively, right? If you look at the total stimulus from April 24, it's roughly about $800 billion, which is 4.5% of GDP for China. That's a very big stimulus that they have given. But I guess the recent data also shows that it's not just money to China, it's also money to Japan that has gone, right? So I think the foreigners are still looking for better entry levels to come into India, right? And I think last few years was never a FII driven market. It was always a domestic flow driven market. It's just that the intensity of selling in the last 1 month has been very, very significant, and that's kind of showing up in the numbers as well. When will it turn? It's anybody's choice. I think at some point in time they can't ignore a market as big as India, because I think there is no structural growth left in any other part of the world. I mean, if you want growth, you have to take more debt or you have to stimulate the economies, and that's where you get growth, right? If you want broad-based growth, I think India is where you will get it. So eventually they'll come.
But how punctured is the HNI, ultra HNI fraternity after the recent market fall?
Look, nobody likes loss of momentum, right? I mean, everybody got carried away with the fact that in the last 4 years, we didn't even have a 5% correction on the Nifty. Now we have a 7% correction. And this is what people were looking for to deploy capital. And I think the market's given you a Diwali sale offer to come and buy.
But no one has the courage to.
It always happens.
Yeah,
it always happens,
case,
you know.
Yeah.
When it's going up, you think it's too expensive. When it is correcting, you don't know. You think it will correct a little bit more, and so people just keep waiting. But to be fair, I think generally speaking, people are committed and invested in the market. It's not that people aren't invested in the market. So I think there's always a question when you want to deploy incremental capital. But they'll come. Once the market starts to accelerate again money will come in.
Yeah, absolutely. But, Hiren, the earnings season, and taking a cue from what you were earlier mentioning, has been kind of an eye-opener as well. Yes, the valuations and therefore those extrapolated rises and falls in the stock price, that aside, but banks, for instance, you always knew the deposit growth is going to be an issue, and it's playing out in very starkly so. And it's also becoming more like an auto kind of story, because every segment within banks and financials is playing out amidst a different theme altogether. How is it that you're looking at opportunities and risks now within the financials cluster?
So Ayesha, I think we've broadly been anti-consensus when it comes to the private banks and financials, right? I mean, we have very little exposure there. Everybody likes the private banks. We think that we are better off buying capital market plays than bank stocks, right? And I think what kind of got us thinking was that the financial year 22-23 was a perfect year for banks. You had the best NII, you had the best credit growth, and you had the least credit costs. And despite that, bank stocks didn't deliver, right? And that got us thinking that how come that you have the best of the three variables and still bank stocks refuse to move. And that told you that I think the problem is that, as you rightly mentioned, that on the liability side, it's becoming difficult to raise deposits. And on the asset side, your most profitable segment is credit cards and unsecured lending. That's where the RBI is very uncomfortable if there is significant growth. So your most profitable segment, the RBI is putting the brakes. And on the liability side, you're finding it difficult to raise deposits unless you substantially raise deposit rates, in which case your NIMs will get impacted. So my sense is that, and I believe that, in this cycle is more for the capital market plays, because you have to follow where the money is. So if the retail household guy is not putting money in deposits and putting money in SIPs markets, or mutual funds, then you are better off buying capital market plays. And I think those have done far better than betting on banks.
Exactly why? But don't you think a large part of that story is also played out already?
Don't we think that capital markets can compound at 12, 13, 14, 15%?
Fair point, yeah.
Right? So, my argument is that when you are playing the big private banks, what growth are we playing? Essentially mid-teens growth, right? And that also not everybody is able to get that kind of growth. Yeah. ICICI probably is an exception. Maybe Axis did well. But neither Kotak nor HDFC has been able to deliver that kind of growth. I think that you can get the same kind of growth in capital market plays, though they may be more volatile. But there are no balance sheet issues because it's a pure operating leverage business. Your AUMs keep compounding at 12, 15, 18%, and your incremental fixed costs don't grow at the same rate. So I think that's a better compounding story than banks today.
So a basket of capital market plays, or specifically something?
No, I think exchanges, mutual, asset managers, wealth managers, online brokers, anything which benefits from money flowing into the capital markets, depositories, right? Anything that benefits from the structural shift of savings into equity markets is a great compounding story for the next few years. Now, again, don't get me wrong, that doesn't mean that banks won't do well. But I think if I take a slightly longer term view, my sense is you'll get better compounding playing the capital market story rather than playing the private bank and the lending story. Because you look at the data, right? Look at MFIs, such horrendous numbers, right? It tells you that the average consumer in this country is struggling. If that would not have been the case, you wouldn't have had this kind of credit costs. If that would not have been the case, that's why your FMCG volumes are so anemic. There is no growth, right? So I think the average consumer is under some kind of stress. So he's only spending what is absolutely necessary. That's why you're not seeing volume growth. He's been hit by inflation in general. And I think his incomes are not compounding at the rate at which they should be compounding. And that's also reflected in unsecured, spike in NPAs on unsecured, on MFI and so on and so forth. So I think the consumer needs to get into slightly better shape before we can, think of going that way.
So clear disconnect, like you're saying, between what premium India is consuming and where, say, the urban poor or the rural economy is actually headed. A clear signal as well to actually bet on the premium end, because be it capital market exposure, although it's going to penetrate even further from here, or anything that you look at from, second quarter numbers so far, I think the messaging is very clear that it's the premium end of the economy which continues to do well, is not hampered by inflation as much.
Yeah, because, the demographics is playing in their favor. Clearly, the slightly more well-heeled households are not so much impacted by inflation, because they also have a massive wealth effect by their holdings in gold and real estate and the stock market, right? And therefore, I think premium consumption in general, or anything that is premiumizing, is doing better, whether it is real estate, whether it is liquor, whether it is, premium SUVs. They are doing better than entry-level cars or affordable housing or FMCG. It's very clear.
It's very clear. So let's talk about this entire premium theme that you just talked about, starting off from real estate and, ending with FMCG. What are the plays that interest you? And do you now buy them afresh at these levels? Because again, a large part of that story is already played out.
So I think, Ayesha, we are very bullish on premium real estate in the country, right? Just think of it in the previous to previous cycle, which is the 2005 to 2003-4 to 2007-8 cycle. The total share of real estate in the market cap was about 6-7%. Today, it's sub 2% for such a big asset class. If you look at the median market cap increase in, let's say, companies with a market cap of 1,000 crores to 10,000 crores in the last 4 years, I think it's at least gone up 4x, 5x, which means a promoter who was, let's say, assuming he has a 50% holding in a 1,000 crore market cap company, was 500 crores. Today it is 2,500 crores. And what does a promoter or anybody or an ultra HNI do when his wealth goes up? He upgrades to a bigger house, he buys a second property, buys a more premium property. Obviously, the top entrepreneurs are going to go and buy real estate in London or Dubai or whatever. But what about the 101st to the 900th promoter in India? And promoters have been selling stakes in their companies. Private equity guys are getting exits.
Yeah.
And I just feel that, over the next few years, you can't have a situation where not a single real estate company is part of Nifty, right? So my sense is that in the long run, premium real estate will do phenomenally well, because Indians are getting wealthy and the stock market has made so many promoters and founders wealthy. And people do like real assets, whether we like it or not.
Absolutely.
When they make a lot of money in the stock market,
Absolutely.
they want to take some money out and buy a couple of houses or flats and park their money there.
Absolutely.
So I think real estate is by far, in my view, one of the best ways to play premium consumption in the country. And also for the developer, at that price point, margins are very good because the customer is not very price sensitive, right? Somebody who's willing to cut a 5 or 10 crore or a 20 crore check, if you show him a better property with 25, where the price goes up by a couple of crores, he's not going to mind it, he's just going to. But if you tell a guy who's buying a 50 lakh flat that, this is another flat which is 60 or 75 lakhs, he's going to think 3 times before he cuts a check, because that's a big capital commitment for him. So I think premium real estate is a great way to play the wealth effect or the wealth story in India.
Within premium real estate as well, it's kind of now difficult to sort of draw the line, because there are so many players who are adding to the pool of premium real estate. It's not just Lodha, but it's now Macrotech, DLF, and the pool is only increasing, and of course Oberoi Realty too.
Yeah, I mean, I think what's happening is that some of the developers who were, let's say, if DLF was very focused on Delhi, NCR, Gurgaon, they are also stepping out a little bit out of their comfort zone and coming to Mumbai. But that's also because the industry has gone through a massive consolidation. So I think all the smaller developers, anybody who, even a 1 building, 2 building guy was calling himself a developer, I think those guys are completely out of the market, right? Yeah. It's all about organized people who can have access to capital. And I think the other thing is that apart from RERA, which has consolidated this industry, today the industry has access to good institutional capital, right? So the big guys have the ability to go to a Blackstone or a GIC or a KKR or whoever, or a private equity guy, or even come to the public markets and do a QIP and raise capital, right? Access to capital was one of the problems of this sector in the previous cycle. They ended up borrowing from NBFCs at crazy rates. So I think, even today, it's a fairly consolidated industry. All said and done, there are just still very few high quality developers. And today consumers don't want to buy unless you have a great brand name and a good quality product.
So brand name also comes to then retail consumption. It's also sort of pilfers through to just so many of these online platforms, etc. as well. That again is the premium end, but those prices in the recent crash haven't quite fallen down as much as one would have liked them to. Where within that do you spot opportunity?
I think it's a great opportunity. The other day I was looking at the total market cap of the top 10 FMCG companies is almost 24-25 lakh crores, right? Starting from Unilever, ITC, all the way down to Marico's and this thing. And I think that's ripe for disruption, right? I think that the quick commerce guys and the online platforms are likely to take away market share from these companies because they are growing at a much faster pace. And there will be pressure on margins for these FMCG companies because increasingly these platforms are becoming the aggregators. They have the financial power today. And I see a day that in a couple of years, they will either spawn newer brands which will compete with the established FMCG brands, or they may create their own private labels, right? And therefore, I think structurally, the FMCG industry is a short in my view, and I would go long the so-called new age platforms, and I would go short the FMCG companies. I mean, just metaphorically, right? I think structurally, just like what happened with private banks taking away market share from public sector banks, right? Because they were more efficient, and I think the same thing is going to happen. The quick commerce and the platform companies are going to take away market share and market cap share away from these FMCG companies who are trading at 60-70 multiple and hardly able to grow 2-3% volume growth. Total PAT growth is so anemic. Why should these companies continue to have such large market caps? So I think there is going to be a market cap transfer from there to the new age companies. We are very bullish on some of those platforms.
So if I were to ask you after this recent fall, if you had $100 and if you had to buy afresh and make a new portfolio for someone who's entering the market for the first time now, where would you deploy that $100? Across all asset classes. So you can include gold and you can include real estate also. Let me make it easier.
Well, I mean, I'm actually an equities guy, so, I mean, though I was not a big fan of gold, but having said that, I think seeing the level of debt that some of the larger developed economies are racking up, I do believe that maybe a small exposure to gold may not be out of place, right? But I would rather focus on equities because I think that's a earning asset class, right? I mean, companies actually grow and make cash flows, and therefore I think longer term equities is the best asset class that you can be in. I think real estate now, if you ask me, is not a price appreciation story. My bullishness on real estate is more because the velocity of sales is improving. I think gone are the days in the previous cycle where people did land banking and then, you know, they wanted to make inventory profits and sit on inventory and let the price go up. I think now most developers have realized that it's all about turning around and increasing the velocity and cash flows.
It's more demand supply kind of thing.
It's more demand supply rather than just playing the price, right? So I still feel that, you know, equities is the best place to be in. And I think structurally in India, because of the financialization that we are seeing, very similar to the US, when their 401k moment came, when the pension funds were allowed to invest in equities, the S&P 500 long-term averages actually settled higher, right? As people keep arguing here that, oh, you know, the Nifty 10-15-year average is 17-18 times forward, and therefore if markets are trading at 22 times, they are very expensive. And I believe that India's 401k moment has come, right? With the kind of SIPs that we are seeing, we're still seeing only 6% of household savings coming into equities. It will eventually get to 10% and 12%. And therefore, one could argue that with the structural growth story that India offers and the fact that structurally we are going to see even more domestic savings come into equity markets, why can't Nifty have a new average at 20 times or 21 times or 22 times, whatever it is? I don't know. The markets, the broad wisdom of the markets will determine that. But I do believe that India's PE multiple will settle at a structurally higher band than what it has historically.
Okay, Hiren, great to have you on the show. We can just go on talking about markets.
I know.
But good speaking with you. And happy Diwali. Hopefully, somewhat 2081 will not have these shake-offs, and this Diwali maybe will just be a bad memory.
Well, I think by the time we get to the next Diwali, we will, you know, we will be in a very good place. But I think, okay, 7-8%, 10% correction is, you know, is par for the course. So I don't see there is any reason to sulk even in this Diwali. But with that, thank you so much for having me.
Thank you.
Happy Diwali to you again and to all the viewers.
Thank you so much.
If you like this video, then like, share and subscribe to ET Now.